Well, I'm absolutely delighted to have these panelists with us this afternoon because, as you know, the topic we're going to be talking about is the future of funding. And you probably couldn't quite tell from the very brief introductions that were given just now. So to just give a little bit more color on this, Lali is from OurCrowd, which is the equity crowdfunding platform that has invested in, is it over 150 companies, and is global. And we have Dr. Julian from TenX, which did an ICO not too long ago. And Robert is from Ayondo, which was the first FinTech to list on the Singapore Stock Exchange. And we also have Brian from EY, who will share with us an overview with all the work that he does working with asset managers, VCs, and other investors. And so, having introduced the panelists a little bit, let me set the scene for this. If we look at the traditional life cycle of a company, it would start off being self-funded, and then friends and family, angel investors, and you typically would think of companies who are aspiring to do an IPO, and in the meanwhile would get funding, as I said, from VCs and angel investors. And the question that I have for the panelists this afternoon is whether or not that very traditional model has turned on its head. And the reason I ask that is because, one, we see so many, not even unicorns, but decacons who stay as private companies, and we see so many different sources of funding. We're going to talk about equity crowdfunding. We're going to talk about ICOs. And with all these different sources of funding, where is the space for VCs in this new ecosystem? You know, as a startup, where do you look for funding in this new world? And I'd like, first of all, to invite Robert to share with us his experience as a company that has listed. Why did you list, and why Singapore?
Good question. No, I guess every company is special. You know, it's got a different history, different investors, different products, and objectives. And when we looked at our next source of funding, we were looking at our objective, and we had two objectives. First of all, obviously to raise funds to grow the business. I think that's the obvious one. The second one, why we chose the IPO, we believe that the IPO will also raise our public awareness, because we are a financial institution. A big part of our business is the B2B business. A public company is always associated with transparency and trust, and that's something actually which we believed and still believe helps us to develop our business. If you look at this event here, which is the biggest FinTech event of the world, so Singapore is not the wrong place to be if you're looking into FinTech. We looked at different stock exchanges, and we found also with SGX, we found quite a fruitful ground to actually further explore listing. And then Singapore being a major Asian hub in general, business hub, finance hub, and Asia being our major market for the future, we believe it can't be wrong to be here. So those are.
And I think that I really want to pick up on your concept of transparency and trust. I'm going to ask Lali to comment on this, because when those companies are raising money through your equity crowdfunding platform, how do you deal with that transparency? How, you know, part of the thinking is to democratize, right? How do you deal with the transparency point?
Okay, I'll answer that, but I'll touch on 2 points that you mentioned before. So you mentioned the traditional sort of growth, starting for friends and family, going through funding rounds, finishing with an IPO or an M&A. And I think actually, even if you start with the first stage of friends and family, we already challenge that. Because if you go through a crowdfunding, if you go through us or a crowdfunding platform, you can already skip the friends and family. Because sometimes the founders, they don't want to deal with friends and family. They don't want to have all those names in the cap table. They want to have one name in the cap table, and they want to finish the round. So even aggregating the friends and family at the first step is already major support for the entrepreneur going forward. Thinking about the cap table, how it's going to look 4 years from now. So that's one. And then the other point you mentioned is staying longer, being private for such a long time and growing in your value. So that means that the asset class of private equity sticks with the company. It doesn't go public. So how can you make people able to invest in these companies? How can people benefit from this asset class? And that's only via equity crowdfunding platforms, because to invest directly, it's either as friends and family very early on, or you need to be extremely wealthy and put very large checks to be able to play that game via VCs. So we are trying to disrupt those two levels already.
And maybe for the benefit of those in the audience who have not done an equity crowdfunding, say, could you explain to us a little bit how it works? For example, even disrupting at the friends and family stage. So I'm a startup, how does it work? How do I get on your platform?
Sure. So our platform is a platform that is open only to accredited investors. I'm from OurCrowd, OurCrowd.com. It's an equity crowdfunding platform for accredited investors only globally. We exist globally in terms of where our investors are coming from. The majority of our investments are done in Israel, but not only. We have 70% of our portfolio in Israel, 30% outside of it. The majority is in the US. In all the companies, we invest across stages, across sectors, and across geographies. Except for pharmaceuticals, this is the only sector we haven't tackled yet. It's a bit too risky, even for us. So otherwise, we invest across sectors. So any investor who's a accredited investor can log in and make investments either in deal-by-deal opportunities or in funds. We, in the last 18 months, we started investing more and more into funds or creating our own funds. So it's actually very simple.
And from the company's perspective, how do I?
So for the company's perspective, we look at companies like any other VC. So it's very deep dive, diligence process. Still, we haven't disrupted the process in terms of we have analysts, principals, associates, principal partners in the investment team. So that has not been disrupted. It's still very difficult to get funded. And we take that extremely seriously. Maybe unlike other platforms, we're not a marketplace, so we're not connecting people with different opportunities. We're diligencing and curating every deal like a VC. So we post on our website our investment memorandum, typically 15, 20-page long analytics of the company. So everything is very transparent. The company, on the other hand, the entrepreneur, has to be willing to be transparent. It's a very transparent platform. We have edge cases for deals that are subject to NDA, specific NDA. But other than that, the majority is extremely transparent. The diligence documents and the deal terms are very transparent.
So they are transparent. I imagine the process would be similar but a lighter touch than what, say, Ayondo had to go through in an IPO context. And I think the other kind of fundraising where people seem to have a lot of questions around transparency would be ICOs. That's the other sort of extreme, because there are a lot of, I'm going to quote you, Julian, right now, flying ponies out there. So how did you demonstrate that you were not a flying pony?
I mean, we did our ICO around 1.5 years ago. We were not the first one in Singapore, but I think still to date, we did the largest one with $80 million. I think part of, if you can call it maybe a step of a success, I definitely don't think it was the end, but this part of the success was because we were insanely transparent leading up to that by introducing the team, showing what we have, having our customers speak for us, showing the product. We had an angel round and a VC round prior to that of approximately 1.1 million. So obviously we had institutional money in there that was betting on us. I think that really helped. I guess the other question is, and we see this a lot right now, is how transparent are all these companies doing an ICO right now? 1 year after our ICO, we released what's called a transparency report. We showed how much money do we still have on our balance sheet, what are the salaries in total, what is our burn rate, what is our status quo. And the shocking thing is, from all the, I think, thousands of companies that have done an ICO, so far I'm only aware of 3 companies who have done that. And I don't know. Obviously, there's always a question, how transparent does a startup have to be? Because with that always comes some scrutiny. And I think as a startup, you still need to think very, very long term. But then on the other hand, I think token holders, they do have somewhat, not the right, but I think it's fair to them to kind of show them a bit, hey, this is where we're standing. This is what you could be expecting. So I think finding this balance is the sweet spot. I think that's really important right now about transparency.
Yeah, and you mentioned that startups and scrutiny, they may or may not always go together. So Robert, a question for you, which is, as a listed company, you are subject to all that scrutiny. How have you evolved so that you can deal with that level of compliance post-listing?
Yeah, so I guess being public adds a complete new business stream, so to say, in short, to your business. It's investor relations, it's quarterly reporting, analyst briefing. There's a lot of stuff, it's infrastructure you need to build and maintain, and it comes at a cost. So it changes the whole organization. It definitely increases your costs, but it also leads to improvements in a lot of areas, because you have to be disciplined. You have no choice. You have to have your finances in check because you have to report within 45 days and so on, so on. So it adds a lot of discipline and control in your business and sets a better foundation for further growth. Admittedly, it can be very annoying at sometimes, but it's a good discipline. Plus, you set a new major overwhelming KPI for the company, right? If you look at customer growth, revenue growth, and all these key KPIs, you have a new one, which is the share price. Okay, and it really affects and changes your whole life. I can tell you that one.
It's basically a nightmare.
you get up. Normally, you get up in the morning, get a coffee and check your emails, WhatsApps, whatever. Now, I definitely check the share price first thing, and then there's good days and bad days. And I tell you, the tone for the day is set. Yeah. After looking at the share price. So.
And do you look at your token price? Is that a thing for you?
I mean, I really think that a lot of companies underestimate what this thing does. And don't only consider as a founder, consider every team member. Many team members obviously are betting on the company, so they want to own a token or they want to own part of the success, right? And there's a couple of things, right? I cannot make one tweet, I cannot make one Instagram post, I cannot do anything without having a comment about the token price, about the company, about whatever, right? Completely unrelated. So this is just not possible. So the beginning just kind of ticks you off, and at some point it's just the normal, it's the noise, right? That's just always there. But then you have team members who are not used to that, and they are really struggling with this. And so I know a couple of companies who have done really well pre-ICO, could have done a traditional venture round for, let's say, $5-6 million. Then they go to a round of doing $13, $14, $15 million ICO, thinking, hey, I got a $10 million upside. Don't manage to sell the crypto. They are stuck with crypto. The crypto drops. Now they have less money than they had done with a VC. Plus, they have a token, and they have team members who are completely upset about that. And I know several instances of that. And I think that's the drawback that doesn't get shared. Because people always love to share the success stories, right?
And so, Brian, with your advisor hat on, when people are looking at these different options, what are some of the considerations that you encourage people to think about?
I think the panel has gone through various different ideas on where the funding comes from. Robert went through an IPO, but before that, I'm sure there was his own capital in there, as you mentioned. And also then he got several rounds. But the topic, before I answer that question, just on the ICOs, what we saw from our own studies that from the class of 2017, Julian, 66% of the value is already down in the first half of 2018. A staggering number, like 86%, I think, of the individual tokens are below their issue price. But the good news, or the silver lining, is that the top 10 have increased their values, because they have kept their promises. They have done all those things that you kind of alluded to. So hence, to your point, if you look at what the alternative fundings, VCs is still a fair portion. Based on our FinTech census, based on our studies, our EY report said that VCs is about 22% of what the fintechs are getting in terms of funding. Of course, the large portion comes from their own pocket. That's about 45 to 50%. The PE guys, because they go really more for the late stage funding, they are around 8% or thereabouts. And interestingly enough, government funding or policy from the authorities or policymakers come around at 5%.
And these are Singapore fintechs?
This is ASEAN fintechs. So it's a collation of the 6 key countries within ASEAN and collating those numbers.
So in an ASEAN context, it still is, things like equity crowdfunding,
For sure.
as well as ICOs. Those are still kind of the future,
That's right.
not yet with us.
I think the
in
point to
present.
make here is that the future is almost here in the sense that when you shine the light on what they are doing, when there's that transparency, the common theme that our panelists are talking about, then you get more comfortable. Then you get more institutional money into it, no matter what form it comes in.
Yeah, so you've mentioned the VCs, and I think they are still very much a player, in ASEAN. And, Julian, I'm really interested to hear where you already had VC money, and then you went on to do the ICO. What was their reaction to that?
Obviously we have angels, and then we have 2 VCs in. One is from China, one is from the US. The Chinese one was very familiar with the model. He was very open. They were really, really interested in participating in the ICO. This was it's Fempushi Capital around Vitalik Buterin is one of the co-founders of the fund, co-founder of Ethereum, together with Bo Shen. So they were really, really open because they are from this ecosystem. The American fund, we excluded Americans in our ICO, so they couldn't participate. But also for them, this model back then was so new, they would have not made the decision to participate. But he was open. He didn't. He trusted us. He trusted that we were going to be able to handle the pressure. It was very interesting. With them, we had. Because the fund came out of an insurance company that's public in the US. And so he said, when you go public, be aware you're public. And yes, you don't call it a public offering, but this token is still going to be public. And he understood it very early. And he kind of mentored me into this and said, you're a startup, never forget to never ever trade the long term just for the short term. You're a startup, you need to shoot for the next 3 years, not for the next quarter. And there's so many times that I think of this quote, and I'm so happy that I'm doing this because there's so much pressure every once in a while from token holders. And I'm proud of the entire team that we never give up on this long-term vision because we are a startup. I mean, we're 90 people. This is not comparable to a publicly traded company. Yeah.
And so I think a theme that has come up already is that regardless of the kind of funding that you have, there is going to be a real need for transparency at the fundraise stage as well as after the event. And that that need or that scrutiny that you might come under would still cause a change in the company, perhaps more so in a listed company, but even, the token holders do have a say. Or not have a say, but do have comments, have a Twitter say. Yeah. And I'm curious, in an equity crowdfunding, how many people are we talking about? How do you deal with, so are these all different people on your cap table? I mean, do you have to deal with all these shareholders?
Well, no. So we have 30,000 registered investors to our platform. Unfortunately, not all of them are active investors. We're always looking to convert more into active investors. From our entrepreneurs' perspective, all they see is an SPV in their cap table. So it's very simple. It's an SPV. All of the investors into a company are LPs in that SPV. So the entrepreneur sort of has a buffer between the entrepreneur and the crowd. The challenge is, of course, and that's on our shoulder, is how do you leverage the crowd wisely? How do you find the right value in the crowd and at the same time not overwhelm the entrepreneur with too much noise. So this is our challenge, and what we try to do is to take that challenge, to see the opportunity in it, to identify the value-add investors in the crowd that invested in a company or that have not invested in the company but still are willing to support the company from end to end, from different things that an entrepreneur needs when he grows or she grows the company. So we try to leverage a crowd. We call this crowd building, and we do different sort of exercises of crowd building for the benefit of our portfolio companies. But again, legally and structurally, the founders are not exposed to the crowd.
And is there an expectation of some kind of reporting to the investors?
So we report to the investors every quarter. We put on a report on the status of the company. Obviously, not putting the company in a risk of overexposing the company and its trade secrets. So it's sort of the minimum that the investor needs to know to be comfortable, and the maximum that the entrepreneur is willing to share.
And I think it's really interesting that even in the context of where there's no regulatory requirement to do so, the market forces you to make that kind of disclosure, because for the company to continue to receive funding in their future rounds and so on, so there's more convergence than difference is what I'm hearing.
Yeah, I think there's something here in the essence of engagement. You want the investors to be engaged in the company. The company is there for the longer run. The company is going to stay private longer time, so there's going to be future funding rounds. We're very actively supporting the companies in follow-on rounds. So we want the investors to feel comfortable with the investments. So it's not only when it's required, but also when it's supportive for the investors.
Yeah. And so I'm going to ask a question for Robert, which is, having been through the whole listing process, is there something you think, oh, I wish I'd known that before I started all of this?
Well, first of all, I mean, I guess there is no recipe, right? Each company is completely different, as I said, different history, different objectives. And sometimes it's even not in your hand, even if you want to list, you might encounter problems. It can be problems in your industry. So, people have to abort the IPOs because you wouldn't find the investors because there's a problem in the market. It can be economic cycles, stock market cycles, right? So the window is closed. Right. I talked to a couple of corporate finance people over the last days, and at the moment, IPOs are all delayed from Q4 into sometime next year because the stock market is bad. There's pressure on tech stocks in particular, So even sometimes you do all this work, you want to do it, but you can't do it, and you have to delay it. It's quite bad. So you also need a bit of luck in the whole process. But what I can say for sure, no matter what the outcome is, it's like building a house. It always takes longer, and it's always more expensive than you think. Okay, that is for sure. Yeah.
Good to remember. Lali, for some of your companies, I know you had, was it Rewalk, that was the first sort of equity crowdfunded company that eventually went to list. So, these are not alternatives. They're not binary alternatives. They can all kind of work together. But you deal with so many startups, Lali. Is it still an aspiration for them to list? Is that the ultimate?
Well, I think many of them are very aware of the sort of the nightmare nature of being a listed company, and they have the preference of staying private longer. And at the end of the day, exiting an IPO is an exit form, basically providing you with liquidity. So you're looking to find different ways of finding liquidity. Either ICO, not that one company actually is working on an ICO, but generally this is not the exit path. The more common exit path is being acquired. And we see that more and more with the companies, mostly in Israel, but not only in Israel, that the multinational companies are very, very present and active. CVCs are growing in Israel. The presence is growing in Israel. So we see more and more and more earlier exits through that sort of course of action of selling the company of M&A, sometimes too early. We would like the companies to grow more, stay private longer, and grow the value.
Yeah, and I think that's certainly a global trend, the CVCs. I mean, we are certainly seeing it in Asia as well. And there was a Silicon Valley Bank did a survey last year, and of those almost 1,000 startups surveyed, only 16% said that they thought that they would list, and most of them were expecting, hoping for a buyout from.
Right, even though the
CVC.
CVCs generally are separate investment platforms and the acquisitions are done by the business unit.
Yeah.
So it's sort of even inside the world of corporations, there is the CVC track for investments and then the corp dev and M&A track from the business unit for the acquisitions, sometimes not even being aware on time about each other, so not even speaking to each other. But I think in that sense also equity crowdfunding, at least how we see it, is a game that corporates are playing in as well.
Yeah.
Because we're providing information also for corporate investors and institutional investors, and not only private investors.
Yeah, and I really want to come back to that, the role that you play kind of in the ecosystem. But just before I do that, I have a question for Julian, because we're talking about how these are not binary alternatives and how, you, for example, have VC funding as well as ICO funding. And how do you see it as a complement to fundraising, or is the ICO a more strategic point? Like how did you, or how should one kind of see these two dovetailing?
I think in the past it was definitely complementary. I think it's going to be very interesting looking forward. What's going to happen? I mean, so far, I would say 99.999% of all the ICOs were done with a utility token model, which, let's be honest, is actually not the right token model. There's just no better that we could use right now. At the end, if we look at the function of an ICO, it's to raise money. So why make a new utility token? What you should actually be making is a security token. It's just almost impossible to do this at the moment if you don't want to go as an IPO. So that's why everyone goes the utility token route. The interesting thing is going forward, Singapore is starting with a security token model. Liechtenstein in Europe is going really strong, and more markets all around the world are getting stronger and stronger with security tokens. And then it's going to be very interesting. What's the model going to look like? Is it still going to be open for anyone, for any mom and pop, or is it going to be for accredited investors only? That's going to be very interesting, and then we're going to see the up and downsides of it. I think so far, the model that we had, and I think the model that we had is not going to exist in the next 2 years because the regulator just didn't know these models, and now they're cracking down on some gray areas. But I mean, I thought that was really, really complementary. I thought that was great. I wish that it would exist and keep existing with the same kind of regulatory hurdles. I just see, and you see the statistics are dramatic in how many companies are misusing this model. So what I'm very pro ICO, but then I am quite careful as well. And so the trick is going to be, how can you find the middle ground in not opening it up to everyone, scamming people out of their investments, and then on the other hand, still leaving room for innovation. And I think that's going to be very interesting to see how are these security tokens going to be structured, and that's going to answer that question over the next months and years. Is it going to be complementary, or is it going to be the same thing actually? It's just a different way to get the money.
And building on your point of it's the same thing actually, maybe, when you were going through your ICO process, having gone through a VC funding round, did you find that the processes were similar or entirely different?
I thought it was completely different. First of all, the type of people, obviously, that you deal with. I think in our ICO, first of all, we had to do KYC and AML with pretty much all of them, and I think we had 6,000 people contributing to our ICO. So this was an insane amount of work. Then we talked about this. The interesting thing is the person contributing 5 million, you might think this person would be way more cautious than someone contributing $100. But actually, the exact opposite is true. The person contributing to 5 million does very professional due diligence. They come to the office, they check you, they do background checks, they check anything there is to check. They want to see the business and so on. But then afterwards, they're prepared for this contribution to be maybe relevant for the next 7 to 10 years, where the person contributing $100, and I'm purely generalizing right now, right? That person is not going to think much about it, contributes, sees the $100 go down to 90, completely freaking out. Going up to 200, being completely euphoric. And it's this roller coaster. And so the interaction is completely different. Also, going for advice. If I go on Twitter for advice, I don't know how meaningful feedback is. So I'm not going to call an ICO token holder. I'm going to call the large contributor either that is a VC anyways. And I'm going to call them and say, hey, listen, these are 2-3 challenges we have right now. Could I have your input? So I'm not going to call the 5,000 people because most of them are not the smartest when it comes to feedback for building a business. But I think that applies to any system. This is not only an ICO.
And I'm really glad you talked about kind of seeking that input, because actually that segues slightly to what I was going to come back to you on and unleashing the power of the crowd, because it must be a similar kind of experience for you, that there are, that's the value add that you can add.
Right. I think for us, we see the value of the crowd can be utilized in different contexts. It can be utilized in sourcing a good deal, can be utilized in diligencing a good deal, and obviously, and for me, most importantly, it can be utilized in helping the companies grow, doing business development, networking for the company, and we see that all the time. Sourcing a company, I would say, is an edge case. We have few that have been sourced from the crowd, but it's a very specific crowd. Diligencing a company, there's a huge potential. Many of our investors are experts in their field, like they're true experts. If the company has a cardiology technology, we have extremely expert cardiologists in our crowd. So there can be a lot of expertise that is very much tailored to specific technology, and helping the company grow. This is what we do day in, day out. We use the crowd, uses in a good sense. We use the crowd, we leverage the crowd to network for the company. So it can be very targeted. It can be a founder who's seeking to be in touch with someone specific, and we find the right network to lead to that person. Or it can be something we call crowd building campaign, where a company wants to do a market validation, and we are targeting all the physicians that are US based, because that's the first target market for the company. Or what we also did is we built a platform basically connecting our CEOs with the crowd, with slicing and dicing the crowd according to different parameters. And working with multinational companies, which is another sort of cluster of power from the crowd that we are utilizing.
I think what is quite useful, at least when we were discussing earlier, what wasn't immediately apparent to me is when we talk about unleashing the power of the crowd, it's not the kind of the people, the $100 tweeting, to you, Julian, right? It's really within because you only have accredited investors on your platform. And within that, there will be, people who with particular expertise. So it's not kind of the crowd in a kind of mass sense, if you like, right? That's the distinction.
Even though it is a mass, number of people, and finding the right value is a challenge.
Yeah.
Scaling it is a challenge. Moving from random, ad hoc to something that is more structured, scalable, technologically based is a challenge. But it's also about engaging the people and understanding that people are willing to help, not only if they invested in a company, but also because they're willing to help, because people are helpful.
And so I'd like to segue to a related topic, which is still on VCs. And given the multiplicity of options out there. So Brian, is a question for you. You must know a lot of VCs, talk to a lot of VCs. What's your sense of, how do they feel about all this competition out there?
I think they don't always just focus on the fintechs. They do have their sources of where they feel would be good startups, good companies that's out there. And they are also, in a way, helped by many of the policymakers in ASEAN. Mm-hmm. Many governments do recognize that the SME sector makes out the bulk of the economies in the various countries in ASEAN. And from that, they know that they have a part to play. And when they look at it in combination with certain policymakers in country, in various jurisdictions, trying to create programs that would be useful for startups. For example, if they want to go through a debt arrangement, Enterprise Singapore, for example, they have certain capital loans programs for startups. And I think VCs also understand that there are programs where they can get to understand some of these new entities early on too. For example, we are at the Singapore FinTech Festival, but many of us realize that there's a program called MATCH, and it's an acronym for Meeting ASEAN's Future Champions. And essentially where you look at that, it's a curation or a curated program where you have about 1,000 startups and about 300 investors. And you do basically the matching of the investor and companies and trying to find ways and means to see whether there's any connection there. And I think we as a firm, we helped empower that process, and we came up with about more than 15,000 matches or interactions. And that then brings to the attention of VCs, to your point, about how these startups, these companies are demonstrating that they look at their cost structure, that they are using shared infrastructure to some extent where the security is okay, to the extent that they're using open source solutions. That's one area. Second, speed to market. Are they addressing the market needs, customer needs through customized solutions, but at a speed that the market wants? Three, in relation to perhaps customer acquisition. If you think about it, with the use of mobile, that's everyone in ASEAN is using, in Singapore and everywhere else. How do you sell through the mobile? How do you then utilize that kind of platform to use? And I guess ultimately it boils down to those kind of factors that the VC will look at, and of course, in addition to doing all the due diligence that Lali has mentioned, and the rest of the key sources of funding that want to go through. They're not going to give it just like that. They want to have that level of due diligence.
Yeah, so get ready for diligence, I think is the message that I got for that. And so I'm going to ask, before we go to questions from the floor that have been submitted via Pigeonhole, the final question for the other members of the panel, because Brian has kind of answered it a little bit, is that...
Sorry.
No, which is good. Which is good. That was going to be the question. So any last words of advice to startups out there who are considering their options? Robert?
Yeah, I mean, as I said earlier, there's no universal recipe here. I think really you have to just bear in mind that the process can be quite long. There might be external effects which might make it even longer, and you have to.
And any process that includes lawyers and accountants can't be fun, right? By definition. Sorry, Brian, including us both in that.
No. But it's very important that you factor that in, okay? So you don't run out of money, so to say. And it's very, very important that you have a reserve built in just in case something goes wrong along the line, because it's quite a tedious process. And yet you should always have a plan B as well. That's what I would say.
I would tag along completely with this. I still think we would do it the same way again had we to do the last 3.5 years. Start with traditional funding. It builds credibility. You have mentors. If you get smart money, not dumb money, you have people who are going to help you, have great connections, and then leverage the crowd. Get a product, have users, make your users become the believers in your company. And I think that's what we did, and that was very, very successful. And I would do the same thing again that way. I would recommend any company to do it the same way.
I think from our perspective, collaboration and partnering with strategic partners is a key. And I'm saying that here specifically in the context of Singapore FinTech Festival. One of the key reasons why we're here is thanks to UOB. UOB has been a supporting partner for us, literally opening doors for us in Asia through here from Singapore, and enlightening us in the sense that it's very pleasant to do business in Singapore, and it's very pleasant to work with partners such as UOB and other banking institutions that are supporting us.
The difficulty for being the last one, if you still want to hear my thoughts, is that I truly had some of the points that you guys have mentioned, but I was thinking then I had to come up with a non-accountant's viewpoint in that sense. So I would say that startups just focus really on innovation. That's what got them there in the first place. That's got them with the ideas. If they do that properly with the mindset that they got to be transparent in how they present those ideas and show how they're going to be commercial in nature, and those funding will come in. So it's almost, if I can end, just call it institutionalizing that behavior of innovation. I know it's a misnomer, or you want to call it a oxymoron, but that, I think, would be the way forward. Institutionalize that innovation within the organization.
Great. That's a great note to end it on. Thank you, Brian. So we're going to turn to some of the questions that we have from the floor in our last 5 minutes. And the first question was on transparency. And the question is, does transparency endanger the business model to copycats before sufficient funding is achieved? Any thoughts on that one? Julian, maybe from you?
Sure. It depends on what does transparency mean to you. Does it mean that you share every single little thing? Then maybe. I still believe ideas are quite worthless. I still think the execution is all that counts. But it doesn't mean that I would share every single thing. But again, I think this doesn't give you the excuse of saying I'm not going to share anything because I might, the information might get stolen. So I think it's always, it's not binary, it's not all or nothing, there's somewhere in the middle. And I guess that's the key thing there. And as a good entrepreneur, as a good operator, you should understand what is this fine line, or at least you should test it and kind of adapt.
And on Billions, the TV show, it had a great line. It said, you can watch as many Kung Fu movies as you like. Doesn't mean you're going to know how to do Kung Fu. So that's your execution point.
I would add to that it used to be that you're protecting yourself, you're protecting your idea with an IP or with brand building. Either you go to market very quickly, very smartly, very smoothly, and you build a brand, and there's a brand value, or there's IP. What we see now is sort of a smurf. Like we see companies with brilliant technologies, very well protected with IPs, but giant technology companies smashing their IPs, and they can't really go through the line of lawsuits. And we see, but they manage through different ways. They manage through smart go-to-market and business development. And we see brands, going through other directions. So I think there's sort of different ways of looking at it these days.
Yeah, so for me, just one extra point to add to that. I mean, at the end of the day, it's the execution, as we all said. But the transparency itself is not well defined. So perhaps think about the governance of that process. I mean, there are things that ought to be known and things that clearly is business related, and to the extent it doesn't build towards the governance aspect of the overall discussion or the transaction, I think that's fine. That isn't something that you need to disclose.
Great. Well, thank you very much, panelists, for a great discussion. And thank you to the audience for listening and for your questions.
Fantastic. Thank you.
Thank you.